Hello everyone, welcome to the Market Outlook video series. And today I'm joined by a very special guest, Mr. Manpreet Gill, CIO AME region for Standard Chartered Bank. Hello Manpreet, welcome back to India.
Thanks very much. Thanks for having me on this video again.
So Manpreet, 2025 was quite a good year for global assets. We had a positive risk sentiment and positive market performance for global equities. Do we see that trend continuing, and what are the key macro trends we see in 2026?
So we're actually still fairly optimistic for 2026. We actually think the macro environment can continue to be supportive enough for financial markets, with the only caveat that we may get a few more bumps along the way. Not environment where markets go up in a straight line. But from an investor's perspective, for us, 2026 boils down to three big picture themes within that constructive macro growth inflation backdrop. Number one is that we still expect equity markets to inflate. So we're overweight equities. We still think they're a better place to be than bonds and cash. And that applies to most regions, including here in India, right? Second is that focusing on bond yields, right? Bonds also face elevated valuations, a bit like equities in many parts of the world, like the US. But we still think they're a good source of yield because credit quality is still holding up fairly well. And third is that we do think diversification is increasingly important. And some of that stems from the valuation debate around equities, particularly the AI theme. But some of that also saying, look, there are always a lot of uncertainties around us. Gold's been a great example of a diversifier. That continues to perform well. We think that is further to go. But where possible, we'd also want to add some mix of alternatives to that. So we think that combination of overweight equities that continue to inflate with a few speed bumps, using bonds for yield and adding diversifiers, that we think will be a winning strategy in 2026.
So Manpreet, I wanted to talk about the AI theme because our title for the global outlook is Blowing Bubbles. So are we seeing a bubble in AI?
Well, that pretty much was the central debate when we were putting together the outlook, and arguably still is, right? There's no doubt that valuations for the US AI sector or the technology sector are on the higher side, right? But the big question for us when trying to gauge whether they're in a bubble or not is whether those valuations are justified. And I recognize there's always the caveat that you never know something's a bubble until after the fact. But we tried doing a comparison with the 1999.com bubble.
Yeah.
And what really stands out to us is 1999 was a stock market gain that was characterized by the absence of strong profit growth. Right, so you see quite a big gap open up, and no surprise, we know post-facto it was a bubble, and markets fell back eventually to match the actual earnings growth. The key difference with today is that earnings growth in the AI and the technology sector is actually very strong. So yes, we can debate whether valuations are justified or a bit on the higher side, and we need to diversify to help compensate to some degree of that risk. But there's no doubt that there's a very, very strong earnings growth backdrop. And that's why we're retaining, in our global allocation, our overweight to the US and our overweight to the US technology sector. We still want to be invested in that theme.
The other key call which you have made is you all have upgraded India. So what are the drivers for your upgrade of Indian equities? And can India and China both perform?
It's a great question. Actually, that's where we started. And actually, it's surprising. Going back in history, they can. In the past couple of decades, there have been about 20% of monthly returns. We've seen India and China, outperform Asia ex Japan at the same time. So it is somewhat counterintuitive, but it indeed is possible in a fairly wide range of scenarios. Now, the upgrade to India is, there are a few factors behind it. Someone pointed out to me that actually one reason is that there's, at least as far as the listed market is concerned, Indian equities are not AI. So they actually provide you a bit of diversification against that theme. But more importantly, I think our view is there's a lot of bad news in the price. Right? So if you look at relative performance, so India relative to Asia, Japan, the extent of underperformance has been quite dramatic. Right? You have to go back to the 1990s to find a similar level of underperformance. So yes, while we get some of the challenges that have, the economy and particularly earnings growth has faced in recent quarters, we do think markets are more than pricing that in to the point where you just need less bad news to potentially unlock some of that performance. And that's coming at a time when, in our view, the corporate earnings cycle is actually starting to improve. And we think that's a great combination, especially when coming at a time when we've seen North Asian equities like Korea, for example, already deliver extremely strong performance.
So finally, Manpreet, we are positive, but I'm sure there are risks also, or factors which you would be monitoring or watching out for? What are the key risks which you're watching out for in 2026?
So there are a few, and I always emphasize when you go looking for risks, you always find many.
Yeah.
But three we sort of keep a close watch on, right? I think one is AI valuations. So while we think they're justified, I think we'd always be on watch for signs that markets expectations, you know, go so high that even a great outcome results in a disappointment. Second is that we know we live in a world where policy is always a risk, whether that's from the US or elsewhere. But third, and I think the most sort of understated or less recognized risk out there is actually what's happening in Japan.
Yeah.
Because at a time when the rest of the economy is doing well, inflation's coming down, Europe has cut rates, India's cut rates, the US is cutting rates. The Bank of Japan is actually raising interest rates. And if you look at long-term bond yields, long-term Japanese bond yields are now approaching or exceeding, equivalent bond yields in Europe and the rest of Asia. Now, this is important because for many decades, Japan's been a great source of global liquidity because interest rates have been at zero or not far from zero. So, look, we think the gap today is still wide. If you compare where the Bank of Japan's policy rate is versus the Fed, there's still a decent gap, but it is closing. So, in terms of the risk, we think that's one that's not imminent, but worth keeping a close watch on, only because it's not as well appreciated as AI valuations or geopolitics.
Thank you, Manpreet, for laying out the outlook for 2026. And I hope you're having a good roadshow in India.
I always do. But thank you for having me here.
Thank you.